So obviously right from the start, alternative rock was not for everyone. And the same could be said for alternative investments. But it isn't just a matter of taste that determines whether alternative investments might be right for you. There are a lot of factors to consider and a lot of risks to be aware of. It's that time again, time to tune out the hype and focus on the facts. Yes, facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. So normally when we discuss alternative investments on this show, we use the word alternative in the layman's sense of the term. Why? Because when most people think about investing, they automatically think of things like stocks and mutual funds. So for many, bonds and bond-like instruments and other types of income-generating investments are considered alternatives. But technically speaking, the word alternative in the financial industry means something totally different. It refers to financial strategies that generally carry more risk than even the stock market and have other characteristics that limit their usage mainly to institutional and very affluent investors. Mainly, but not necessarily in its entirety. You see, today, some alternative investments are feasible and even popular options among everyday investors. But how practical are they and how safe are they? And depending upon your situation, could one work as a viable addition to your own retirement strategy? We'll answer all those questions today and many more. And joining us will be author, CFA, and CFP Peter Lazaroff, the co-chief investment officer of PlanCore Wealth Management firm.
If the goal is, hey, I want to increase my diversification and lower the overall volatility of the portfolio, well, that might be a different segment of alternatives, and you are really just looking for assets that are lowly correlated to your existing set of investments.
Along with David McIlvaney, the CEO of the McIlvaney Financial Companies, including International Collectors Associates, Vaulted, McIlvaney Wealth Management, and the Tactical Short.
But do be aware, we've seen plenty of shocks as we've seen things just even the last 12 months move from the periphery to the core. It's not just Argentina and Turkey, but we had two really nice little wake-up calls this last year with the VIX explosion in January of 2018 and then in the fourth quarter. Again, not something that the Fed's necessarily in control of.
But right now, let's take a broad look at the world of so-called alternative investments.
Maximum security. Country has 1-2 down to the line.
And of course, as usual, millions watched this year's Kentucky Derby just a few weeks ago. It's not something most of us think about when we watch the race, but on some level, we all understand. Those beautiful thoroughbreds flying around the track are actually investments. A racehorse might be considered a classic example of a certain type of alternative investment, a type that illustrates the point that I made at the top of the show. You see, historically, most alternative investments are held by affluent institutional investors, or at least by accredited high net worth individuals. Now that's changed somewhat in recent years, but the reasons haven't. See, alternative investments are often limited to wealthy investors because they're higher risk, and they're also higher reward options that frequently require a certain level of wealth in the first place in order to be able to even consider pursuing. For example, some are open only to accredited investors with a specific amount of liquid net worth. And while investing in a real asset, like a racehorse or antique car, might end up being profitable, financial gain isn't necessarily the main motivation for many of these types of investors. Often it's more about prestige or just because they have a particular interest or passion in the investment field itself. But what are some other types of alternative investments? Well, the category of real assets also includes things like art, antiques, coins, and other collectibles. Other alternative investment categories include things like private equity or venture capital, which we'll discuss later on the show, commodities, hedge funds, managed futures and derivatives contracts. Real estate can sometimes also be considered an alternative investment, but not always the case. We'll also talk more about real estate as an investment a bit later in the show. Now, while there are huge differences between the many different types of alternative investments, there are also some common denominators. For example, many have high minimum investment requirements and reasonably high fee structures, especially compared to things like mutual funds and exchange-traded funds. Naturally, this is another reason that most are mainly pursued by more affluent investors. The initial purchase price for a racehorse, for example, is over $60,000. And yes, it can quickly rise into the seven figures. And you can usually double that price once you tack on veterinarian, travel, and registration costs. Another common characteristic of alternative investments is that they're less likely to have verifiable performance data to help you make a decision as to their level of risk. Another is that most are fairly illiquid, especially compared to the more traditional investments we always talk about on the show. Now, once you put your money in, it can oftentimes be very hard to get it back out again. And that means even just getting your principal back, let alone earning a profit. And one reason, of course, is that lack of liquidity we talked about is the law of supply and demand. It's often more fluid and uncertain in the world of alternative investments. For example, even if you have a rare bottle of wine that you estimate to be worth $100,000, it might be much harder to sell it than to sell shares of a certain stock. Why? Because the pool of potential buyers for the wine is clearly going to be much, much smaller. Another common trait of alternative investments is that they're often subject to less clear legal structure than regular investments. And they also generally have less regulatory oversight. Yes, many do fall under the jurisdiction of the Dodd-Frank Consumer Protection Act, and some are monitored by the Securities and Exchange Commission. But some may not even have to actually register with the SEC. And in general, they're not regulated nearly as closely as things like mutual funds, ETFs, bonds, and other of more common investment vehicles. Now, this actually increases the risk potential of alternative investments in another way, by making them more prone to scams and to fraud. Here's the bottom line for alternative investments overall. They tend to carry more risk than traditional investments for a variety of reasons. They're held mostly by wealthier investors for reasons other than serving as a source of retirement income, for example. And that second point is oftentimes the most important one to keep in mind. But does it automatically mean that these kinds of alternative investments have no place in the portfolios of everyday investors saving for retirement? Well, we'll be answering that coming up in just a bit. And now it's time to welcome our first guest, Peter Lazaroff, the co-chief investment officer of the wealth management firm PlanCore. He's the author of Making Money Simple, the complete guide to getting your financial house in order and keeping it that way forever. Peter's also nationally recognized as a speaker, and he's a regular contributor to the Wall Street Journal and to Forbes. Peter, thanks for being on the show today.
Well, David, thanks for having me.
Now, we spoke off air just a little bit, and I know you said that 99% of the time you don't utilize alternatives. They're not bad, but most of the time traditional investments serve an average investor better. But you said, in that 1 or 2% where you do use alternatives, you find that they fall into two categories. People are trying to achieve two different goals. Tell us about those, please.
Well, so I think for a very small segment, and particularly it's PlanCorp's family office where we have more alternative exposure. PlanCorp manages a little over $4 billion in assets, but the family office are people with net worth typically in the 100 million or above category. And I think if you are going into alternatives, the most important thing is to understand why you are doing it. And I think a lot of people go into it because they think expected returns on a stock bond portfolio are going to be lower. That's fine. I think there's a segment more private investment, so private credit strategies, private real estate, private equity, some hedge fund strategies that are more likely to be return enhancers. Whereas if the goal is, hey, I want to increase my diversification and lower the overall volatility of the portfolio, well, that might be a different segment of alternatives. And you are really just looking for assets that are lowly correlated to your existing set of investments.
Now, you'd said that at one point that the best portfolio is one that you can stick with. And oftentimes it's difficult to stick with alternatives for the long term. Why is that?
Well, I think what is challenging is that the expectations for alternatives going in are not always set correctly. And so it's difficult to stick with something that is lowly correlated to stocks and bonds, because if stocks are up and this alternative asset isn't really up as much, then you're a little disappointed. And then stocks are down, and well, gosh, what if that asset is also down? Then you think, why do I own this? And they're a little more complicated, they're a little more complex, and it's easy to ditch something that you don't understand. And so while, again, I'll reemphasize, there's nothing inherently wrong with alternative investments. I just think that truly understanding what you own and understanding the philosophy behind it is really what holds it all together when it appears to be falling apart. When it appears to, performance will make you think that something is broken. But really, if you have a true understanding, then you might realize, oh, well, this is actually what I signed up for, and it is doing its purpose. For me, I'm more concerned about implementing a bad idea than missing out on a good one. And as a result, I think that kind of drives the philosophy.
What do you mean by that? Explain that, please.
Well, it's a good question. So, there's a lot of great strategies out there where the research shows that will improve returns. If I'm not as concerned about if I'm concerned about implementing a bad idea, it means that the bar for adding an additional strategy is very high, because I know that there's a diminishing marginal benefit to each additional strategy I add to the portfolio. The more and more strategies you add, you're not really improving the end result over the portfolio that much. If the bar is really high for inclusion, then we'll probably miss out on a couple good ideas along the way. If the bar is really low, then you're going to implement a lot of things that ultimately don't improve the portfolio. And it's really no different than the way, say, like the FDA approves drugs. They'll try to approve drugs that have minimal bad side effects and where the benefits to the public outweigh those bad side effects. But in doing that, they sometimes fail to approve drugs that ultimately help. They worry about the side effects, but you have to have that trade-off. In statistics, it's actually called type 1 and type 2 error, but we won't go quite there. But generally speaking, I think...
Bottom line is it's the unconscious mind, right? If you're more focused on preventing losses than you are focused on getting gains, well, your unconscious mind is going to attract more losses, and that's what you don't want. So it makes sense to me. We need to leave it there for this segment. We'll be right back in a minute. Stay with us. We'll be right back after the commercial break. I'm David Scranton, and you're watching The Income Generation. We'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Next into the tank is a product to ensure you're covered.
Even if you're not a
wherever you go.
fan, odds are that you've at least heard of the show Shark Tank. Every week, inventors and entrepreneurs pitch their business proposals to wealthy investors like Mark Cuban and Kevin O'Leary, hoping to win investment capital. In fact, the entire Shark Tank concept is built around the concept of private capital investing, an alternative strategy that's once again mainly taken on by affluent investors. Mainly, but not exclusively. You see, the private capital markets are actually open to everyday investors as of late, but only indirectly. Average investors can participate in buying stock with a company that then turns around and invests their money in private equity, or into a mutual fund, for example, that makes various private equity investments. Now, there are actually private equity firms that specialize in this type of investing. They typically raise funds and take capital from both non-institutional as well as institutional investors, which is then used to place investments in promising private companies. The capital and any subsequent gains are returned to investors, minus the private equity firm's management fee and performance fee. And this happens when there's an exit event, such as an IPO or some sort of acquisition. Private equity is a general classification that includes financing throughout different places, different phases, if you will, of a company's growth. By contrast, though, private equity firms that focus on raising capitals for companies in the very early stages of growth are often referred to as being venture capitalists. The people who make venture capital investments are, again, typically high institutional investors, high net worth individuals, because in many ways, obviously, if you're investing at the earlier stages of a company, it can actually be riskier than private equity as a general category. In this case, you're not investing in a company that's already established and functioning, but alternatively in one that's raising money to just get itself off the ground. Here again, the only way a non-accredited average investor can be involved in venture capital is through indirect investment, through a fund or by owning the stock of a company that does venture capital investing. So venture capital is also sometimes called angel investing. And the bottom line is this is another example of one of the most risky potential alternative strategies that exist. Now, the upshot, of course, is that it can produce incredibly outsized returns if the company has a successful liquidity event. And you've all heard of some mega companies out there that began as startups with venture capital investors and made all their investors extremely wealthy. But for every one, there are many that simply don't succeed. Another option in the private capital market is what's called friends and family rounds, which, just as the name implies, is an investment round made up of, well, friends and family. So obviously, average investors can participate in this type of alternative strategy directly by backing friends and family members with investment in a startup company. This, though, is extremely risky, again, because the majority of startups eventually fail. And it's also riskier than having money invested in a venture capital fund, because the venture capital fund is likely to have 20, 30 different startups. So at least it's diverse. The odds of one or two of those becoming successful are pretty significant. In a friends and family round, all your money's tied up, and therefore all your risk hinges on one particular startup investment. Now, as you may know, another way for the average investor to participate indirectly in capital investing is through something called a business development company, or a BDC. A BDC is actually a closed-end investment company that helps small companies meet their capital needs and grow. But are BDCs considered an alternative investment? Well, it depends. If the BDC is publicly traded, then the answer is typically no, because you can buy a BDC pretty much anytime the market's open, and you can turn around and sell it just every bit as quickly. But sometimes the company may not want to deal with the restrictions that come with being publicly traded, or with the quarterly earnings reports or pressure from Wall Street every quarter, in which case this BDC may opt to not have an IPO. And if that happens, it becomes what's called a private placement. The BDC would then be considered an alternative investment. And as such, it might again be open only to accredited high net worth investors, and of course carry all the extreme risks of other alternative investments, including limited regulation, transparency, and especially limited liquidity. Now, these same differences apply to some common types of indirect real estate investing, real estate investment trusts, or REITs. For example, private placement REITs would be considered alternatives in the technical sense of the word, not just the layman's sense, the technical sense. While publicly traded REITs, on the other hand, those that are liquid, might be considered alternative only in the layman's sense of the word. We'll talk more about that, investing in real estate, coming up in just a bit. And now it's time to welcome back Peter Lazaroff, the co-chief investment officer of the wealth management firm PlanCore, and also the author of the book, Making Money Simple. So Peter, let's talk about making money simple. You say in the book that, or the purpose of the book, I should say, is to give people guidance on how to put their financial houses in order and how to keep it that way forever. Can you please share some of those tips with our income generation members on how to do that?
Sure. Well, let me start by saying that financial success is not magic. It's really just a matter of engineering. And so I think the most important thing is being intentional and creating systems that will allow you to make good decisions with very little effort and ongoing effort. Make it really easy to do the right thing over and over and over again. For investments, I think the more automation that you can build into your investment plan, the better. And automation doesn't have to just mean technology. The definition of automation is to operate independently. So if you hire an advisor, you are in many ways automating your finances. But I do think using technological automation or human automation is a big benefit. One of the things that I realized in writing the book was it also is really hard to decide, well, there's all these different decisions. Where do I start? And so in Making Money Simple, the goal is to focus just on a few important decisions so that you don't get overwhelmed by the many different choices. And then I also developed something called smartmoneyquiz.com to also do that, where you just answer 8 or 9 questions and it kind of directs you as to where to go and what are next steps. When you read the book, though, you kind of could do the whole thing yourself. It's designed to give you everything you need to manage your own money. I think what people tend to find, though, is, hey, I'm really busy, or there's this one piece I don't really know how to do, and then the book concludes with how do you find someone who could help you that's perfect for your needs.
Yeah, it's interesting. You use the word framework, I believe, in the book, where you say you don't really need to be an expert to achieve financial freedom. What you need is a framework that makes the right choices simple and easy to make. So can you explain that to our income generation viewers in the 1 minute we have left in the segment?
So I think the framework that's most important from the book is that of the goal setting framework and backing into the types of savings decisions you need to make, and then just living life easily from there. Because if you know where you're trying to go and you know where you are, you can set up automatic deposits for specific goals, and some of those will be invested, some of them will be not. But then you don't have to worry about it anymore, and you can eat out, or you can go to the grocery store, you can go to a concert or a sporting event, knowing that you are on track for the things that you have carefully sat down and prioritized, either on your own or with a significant other.
Mm-hmm. So basically, take the human error element out of it, take the emotions out of it, and just use this framework, whether it's computer-based or not, to keep you on track. Makes sense.
Yeah, a good system acknowledges that you can't take the human nature out of humans, but you can certainly work around it. And I think that that's really important. We're not designed genetically to be good investors, to make good financial decisions. Once you have a system that acknowledges that, it makes it a lot easier to be successful.
Yep. It's a learned thing. You need a system. Absolutely. Peter, thanks so much for being on the show today. We really appreciate it.
Thank you,
Stay
David.
with us. We'll be back here with more on the income generation. I'm David Scranton, and we'll be right back.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. So exactly what are some other alternative investments favored by or restricted to affluent investors? Well, others we haven't discussed yet include hedge funds, which can be highly complex and actually became somewhat infamous in the wake of Bernie Madoff's devious Ponzi scheme. Others include fund-to-funds investments and private placement debt. But as for alternative investments more popular among and accessible to everyday investors, they include 2 classes of real assets: real estate and collectibles. We've actually done separate shows focusing on each of these investment strategies so far. So let me share a brief recap of some of the most important things to keep in mind. Like all alternative investments, real estate investing might be considered a high-risk, high-reward strategy, just depending upon how you invest in the real estate itself. And there are a couple of different ways to do that. One of the most popular things today on TV, thanks to reality television, is real estate trading, also known as flipping. Basically, this is where you invest in a piece of property, typically a house, you make improvements, and you quickly resell it at a higher price. The key word is quickly. Why? So you minimize the costs that come up with home ownership. The more common approach to real estate investing, though, is purchasing ownership interest in a house or commercial property and really gaining the rental income from that property. I would agree that the level of risk involved in flipping actually makes it an alternative investment strategy in the technical sense. But I would argue that investing in rental property is a much sounder strategy and really is only considered an alternative investment in the layman's sense of the term. Why? Because it's a strategy that involves investing by contract. And when you invest by contract, it can make all the difference in the world. We'll talk about this coming up in just a bit. Now, as I already mentioned, the less direct approach to real estate investing is to buy shares of a publicly traded real estate company, which often means putting money in a real estate investment trust or a REIT. Oftentimes, the REIT itself will own many different properties. And as I've explained, if the REIT is a private placement company, then it would be considered alternative in the technical sense of the word. If it's publicly traded, however, then it would be considered alternative only really in the layman's definition of the word. As a matter of fact, REITs have traditionally been a tool favored by financial advisors who specialize in income and dividend generating strategies. But REITs aren't for everyone, and their potential value to a portfolio depends upon many factors. Investing in real estate itself may seem like a simple concept, and most often you'll hear it hyped in the media as a hot option. But as a strategy for most everyday investors who are retired or those within 10 years of retirement, many times it's just not practical, especially with so much uncertainty in today's economy and in the financial markets. Another hot alternative strategy these days, particularly among boomers, is investing in collectibles. Now, generally, a collectible is considered to be any physical asset that has the potential to appreciate in value over time because it's rare or because a lot of people just want it. Traditional collectibles include things like jewelry, stamps, coins, fine art, baseball cards, and so on. But the truth is that just about anything can be a collectible. Guitars, records, dolls, toys, you name it. And in fact, collectibles are hotter than ever before because nostalgic baby boomers have created new markets for a wide variety of items. Now, obviously investing in collectibles is an alternative strategy, not strictly limited to very affluent investors. And many everyday investors like to dabble in it strictly or mostly for the nostalgia factor. And that's okay. But if you're investing a significant amount of your savings in collectibles in the hope of selling your collection at a huge profit just a few years down the road, well then that could be a huge problem. You see, in that case, you're engaging in a strategy no different from investing in the riskiest and most exclusive alternative investments. Many unpredictable factors can impact supply and demand in the collectibles market, causing values to fluctuate wildly. And generally speaking, collectibles are like common stocks, an investment based almost exclusively on capital appreciation with no income. In other words, based upon growth, which as we know can sometimes turn into shrinkage. And like common stocks and most other types of conventional investments, they aren't contractually based. We'll talk in a moment a little bit more about the importance of having investments that are contractually based. Now it's time to welcome our next guest, David McIlvaney. He's the CEO of the McIlvaney Financial Companies, including International Collectors Associates, Vaulted, McIlvaney Wealth Management, and The Tactical Short. He's also the author of the book, The Intentional Legacy. David, thanks for joining us today.
Great to be with you. I'm excited about our conversation today.
Now, you know, we talked about how alternative investments as a class mean different things to different people. And in most cases, for most investors, let's say 90%, our last guest, Heck, said 99% of investors, are for whom alternatives are really not suitable. But let's talk about that 1% for whom they are suitable. When do you see alternative investments really fitting in? For what purpose and what types in your personal experience?
Yeah, so I think the first thing to say is that diversification is key, whether or not you're in that 1% or not. And you have a wide array of choices if you do have a few more dollars to push around. So diversification is pretty critical. What you gain with some of your alternatives is the ability to move towards non-correlated assets, things that don't necessarily move right in lockstep with the stock or bond market, but may offer a positive rate of return just geared a little bit differently.
Now, it's interesting. Our last guest made a comment that he said they're very difficult to stick with, these alternatives, when you're buying an alternative for diversification purposes like you just described. Why? Because the average investor says, well, the asset itself is going up, this alternative is going down, I want to sell it. But that is the point of diversification, isn't it? One zigs while the other zags. So what do people need to do in order to stick with that initial plan if they're using alternatives for diversification?
That's a great point, because I think one of the biggest things fighting against investor success is investor psychology. If something's working, you want to be all in on that theme. But the thing is, we don't have really a crystal ball to know what the future holds. So to be all in on one theme, really you don't know what happens next. And it can be painful, even catastrophic. So diversification is a key. We ran some numbers back in the 60s and again in the 2017, 2018, comparing growth stocks and gold, and found a good mix between the two because it does exactly what you're describing. It offsets some of the downstrokes that you can have in the equity markets. If you have a massive sell-off in equities, you may be playing the patience game to wait for things to recover. With a gold position, you typically have growth to offset the losses, and you never have any real big drawdowns as long as you have the right balance between those assets.
So in some ways then, in the spirit of sticking with the plan, the fact that a lot of alternatives are illiquid can actually work out to be a benefit, because in a way it kind of forces investors to stay with the plan, doesn't it?
It does. And I will say the numbers that we ran assumed an annual rebalance at the end of the year, so that you're always using the same discipline, going back to your point of sticking with the plan. But the discipline is rebalance at the end of the year, so that which is strong, part of it's being reallocated to that which is weak, and you're lowering your average cost basis. So the disciplines of an investor are really, really critical.
That's great. We need to take a commercial break. We come back. I want to talk about the tactical short. So I'll give you just a moment to think about what is it that you think people should consider shorting right now if they're going to go short. So you got a couple minutes to think about that during the break. We'll be right back, and you stay with us too. We'll be right back in a moment here on The Income Generation. I'm David Scranton. I'm here with David McElvaney, and we'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
A bit earlier in the show, I mentioned that I would consider house flipping to be a type of high-risk alternative investment in the technical sense of the word. But investing in a rental property, I argued, was not technically an alternative strategy because it was contract-based. The concept of being contract-based means that it decreases the amount of risk the investment has. And that same distinction is what separates most income-based financial strategies from the more conventional stock and mutual fund-based approaches that are used by most advisors. And it makes them alternatives only in the layman's sense of the word. Putting these two concepts together, I sometimes explain the practical value of income-based investing with an analogy about a hypothetical real estate investment, which goes like this. With a typical rental property investment, you have a lease that tells you how much income you're going to receive from the property each and every month from the renter. It's a contract, which again reduces your risk and gives you some assurance that this is going to be a sound investment. The only risk that remains is the question of how much the property is actually going to be worth down the road once you want to sell it. And that, of course, depends on fluctuations in the real estate market as well as other factors which are out of your control. But alternatively, Imagine you have a tenant who signs a contract, agreeing not only to pay you that fixed amount of rental income each and every month, but also to purchase the house from you at a fixed price on a certain date in the future. In this case, your contract with the tenant has removed almost all the risk from the transaction. If real estate values go up in the intervening years, you don't really care because you already know that you'll be getting so much money for the house down the road when it gets bought out from you. If values go down, you also don't care for the very same reason. You don't have to worry or even think about what the value of the house is going to be long term. The only risk remaining is the credit worthiness of the tenant and the possibility of his defaulting on the contract. So basically, what I've just described is an individual bond, which typically comes with a contract that provides two similar guarantees. First, the fixed rate of interest for the life of the bond, which in the real estate analogy is like the guaranteed rental income. And the second guarantee is the return of principal when the bond matures, provided the issuer doesn't default, which again would be like the renter's agreement to buy the house at a fixed price in the future. Individual bonds are a specialty of most income-based financial advisors, and they should not be confused with bond funds, which most advisors tend to use. Why? Because they do not come with these two important guarantees. Guarantees that help ensure you're meeting what should be your most important financial priorities if you're retired or near retirement, and that is protection and income. Guarantees that make them a smart alternative. Now let's welcome back David McAlvany, CEO of the McAlvany Financial Companies and author of the book, The Intentional Legacy. So, I promised right before the commercial break, we talk about shorting based upon one of your companies. And right now, a lot of people might say, gosh, what's out there that we should be shorting? People would say, well, you know, bond prices are high, you could short bonds, the stock market's high, some commodities are, gosh, you could short just about anything right now. It seems like we have this huge asset bubble. Do you find that there's more shorting opportunities now than, let's say, in normal times, or is that incorrect?
The shorting opportunities are increasing, but so is the danger, because you have the possibility of major interventions, which we saw in the first quarter of this year as a classic case in point. The big names that were shorted, the most shorted index, also saw the largest rallies. There was massive short covering in the first quarter of this year. So where there is great opportunity, there's also incredible risk. What we try to do with tactical short is manage that risk down below a threshold where an investor can say, look, I've got a long portfolio in equities, and I'd like to take some of that risk out without having tax consequences from selling off my stocks. I'd like to have a protective sleeve running alongside it. Now, what we've done with tactical short is moderate the short position in light of a mosaic of indicators that give us an idea of whether or not we should be 100% short or down to 50% short or not short at all. So if the market is moving against us, we're not risk indifferent. We're not going to remain short and just sort of take it like a man. It's going to be moderated, and we're going to reduce our short exposure accordingly. So it's a very intelligently managed product with Doug Noland, who's been doing this for 30 plus years, one of the bright minds, and writes for us the Credit Bubble Bulletin, and is a great way to kind of track our thinking on a routine basis if you ever want to read what we affectionately know as the CBB.
Now, in the 40 seconds or so we have left in this segment, our previous guest talked about long-short strategies, where to become a little more market neutral to protect yourself against a downturn, you're long the stronger companies in each sector and you're short the weaker companies. Is that kind of sort of what you try to do when you try to create that collar, if you will?
Yeah, so with the tactical short, we would say there's different times and different phases that you should consider as options for shorting. And, you know, there's points in the if you want to call it a breakdown within the market, where you just don't want to go there. Individual names in the early stages of a market decline are the most dangerous. And so from a risk-adjusted reward standpoint, we're going to avoid those. Indexes in the first phase make the most sense from a risk-adjusted standpoint. And then we'll look at really liquid listed put options and even individual names as a decline gets further along.
Got it.
But after 30 years of
doing
David,
we need to leave it there for this segment. I'm sorry to cut you off, but you can stay with us. I want to ask you some more questions. And you stay with us too. We have to take a commercial break. We'll be right back here on The Income Generation. I'm David Scranton, and we will be right back. Welcome back to The Income Generation. I'm David Scranton, and we're here with David McAlvany, CEO of McAlvany Financial Companies. David, I could tell you're one of the truly good guys. You know why?
Tell me why.
Because half of the time, when I ask somebody to stay for another segment, but I had to cut them off the kneecaps for a commercial break, we come back to the other segment and they're not there anymore. You stuck around, and I thank you for that. But I want to ask you, I want to really boil down this one final thing. What you were saying somewhat before the break was, don't bet against the Fed. And you're right, the Fed seems to be willing to do just about anything to keep the markets elevated. So that does increase the risk of going short in pretty much anything these days, does it not?
Oh, certainly it does. And that's why looking at policy responses, you've got to be sensitive to when and to what degree they may implement something that really messes with your portfolio if you're short. So, yeah, on the other hand, the Fed is not godlike in their ability to control outcomes. So,
But they think they are, correct?
Oh, that's very true. They've confused PhD with GOD, and they are very confident that they can kind of maintain the sun, moon, and stars in their trajectories. So, yeah, I think that's a challenge on the short side. It's also the challenge for someone who owns gold, because there are consequences to the kinds of both fiscal and monetary policies we've been running for not just years, but decades. And so I think there is some patience involved for investors who are on those tracks, whether it's precious metals or on the short side of the market. But do be aware, we've seen plenty of shocks as we've seen things just even in the last 12 months move from the periphery to the core. It's not just Argentina and Turkey, but we had two really nice little wake-up calls this last year with the VIX explosion in January of 2018, and then in the fourth quarter, again, not something that the Fed's necessarily in control of. They can try to stop the declines, and that's in fact what they've done from a policy standpoint. But the fragility is still within the financial system. The amount of leverage in the financial system is immense, and I think something to be aware of.
Hope you don't mind. I'm going to borrow that PhD does not equal GOD. So 45 seconds or less. Have you been able to take advantage on the short side with what's been going on with China by looking at companies where some of their suppliers might be subject to the new tariffs? Has that been a strategy you've been able to utilize successfully at all?
Yeah, well, and this goes back to sort of staging a short position. And in this particular time slice, we're not interested in individual names. So we're very interested in indexes and moderating the risk, being short particular indexes. But it's not quite time to be short individual names. Where we will see, I think, quite a bit of action over the next year or two is as we see this conflict unfold between the U.S. and China. It's not just trade. We're talking about global hegemony, and we're talking about a challenge for who controls the global monetary system. And I think the Chinese are very aspirational, and we're in the incumbent position, but it's something that you should be hedging for. And I think hedging in gold and something like the tactical short does make sense.
If we weren't out of time, I'd love to spend another half an hour talking with you about that particular concept, but we're out of time. David McIlvaney, thanks so much for being on the show.
Thank you, Mr. Scranton. Great to be with you.
And stay with us. We'll be right back here with more on the Income Generation. We'll be right back. I'd like to thank both of our guests for joining us today for another episode of the Income Generation. I'd also like to thank you, our new and returning viewers. You know, when it comes right down to it, just about everything in life is an investment. When you get married, you're investing in your partner and your relationship together. When you decide to have children, the two of you together are investing in your future together as a family. We invest in all kinds of things for all kinds of reasons. We make financial investments, but we also make investments we think might be profitable in other ways. Some institutional and high net worth investors invest in things like hedge funds, racehorses, and private equity, chiefly for financial gain. And they have strategies that allow them to be successful. And then there are others who indulge in alternative investments simply because they have a passion for a particular type of business or investment field. It can be more of an emotional, social, or even lifestyle investment, which they know may or may not pay off financially. In either case, there's one thing these different types of wealthy alternative investors typically have in common. They feel that they can afford to take the risk. Why? Because again, alternative investments on the whole are considered to be much riskier than more conventional investment strategies for a whole variety of reasons. They often have higher minimum investment requirements. They often have less regulation. Very often they have less liquidity and are often subject to different market forces from things like bonds, cash, and equities. Many also have other restrictions that make them available only to accredited high net worth individuals. Now, despite all this, many everyday investors today are involved in alternative investments. And there are more opportunities today than ever before for them to get involved. Maybe you're one of them, and that's fine. It's fine just so long as you too are aware of the risks and that you understand that most alternative strategies are geared primarily toward growth and capital appreciation. Most strategies are not geared toward the main things that investors in or retirement should be focused on, and that is portfolio protection and a reliable, dependable income stream. Now, obviously, I believe this makes them poor options as core financial strategies. In my experience, there are other types of, quote, alternative investments, in the layman's sense of the word, that better serve that purpose. Alternatives to the more conventional stock and mutual fund-based strategies touted by most advisors and by the financial media. Alternatives, again, in the layman's sense of the word, which you can learn more about by consulting with an advisor who specializes in portfolio protection and reliable income. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.